Warren Buffett is the chairman and CEO of Berkshire Hathaway. It is one of the most successful investors of all time. His investment philosophy has been studied and emulated by many investors around the world. Below, we will explore the comprehensive overview of Warren Buffett's investment strategy.
Value investing. Buffett is a disciple of the value investing school, founded by Benjamin Graham and David Dodd. The core idea is to buy stocks that are undervalued based on fundamental analysis and hold them for a long time. Buffett prefers to invest in companies with a durable competitive advantage and hold them indefinitely. He often says his favorite holding period is forever. Buffett calculates the intrinsic value of a stock, which is the value worth based on fundamentals like earnings, dividends, and growth rate. He then compares it with the current market price. If the intrinsic value is significantly higher than the market price, it provides a margin of safety for the investment. Quality businesses. Buffett likes to invest in businesses that have predictable and proven earnings and strong brand recognition and competent management. Economic moats. Buffett is keen on businesses that have an economic moat, which is a competitive advantage that protects them from competition, like strong brand name, cost advantages, and network effects, regulatory advantages, and so on. Conservative financing. He appreciates companies that are conservatively financed, meaning they don't rely heavily on debt to fuel growth. Buffett believes in investing in businesses that he understands thoroughly, or as he puts it, businesses that fall within his circle of competence. Active ownership. Buffett often takes an active role in the companies which he invests, providing them with capital, strategic guidance, and even leadership in some cases. Tax efficiency. Buffett aims to minimize taxes through long-term holdings, as capital gains tax is generally lower than income tax. Economic and market indicators. While Buffett doesn't time the market, he does pay attention to economic indicators to gauge market conditions. However, these indicators do not dictate his investment decisions. Fundamentals or individual companies do. Avoiding speculation. Buffett avoids speculative investments like cryptocurrencies, high growth but unprofitable tech companies, and businesses he doesn't understand. Buffett calculates the intrinsic value of a company, which is its actual worth based on fundamentals. The intrinsic value is often calculated using discounted cash flow analysis. The formula for DCF is this, where CF is the cash flow in the year T and R is the discount rate. Next, we have margin of safety. Once the intrinsic value is calculated, Buffett compares it with the current market price. If the intrinsic value is significantly higher than the market price, it provides a margin of safety for the investment. The margin of safety is calculated as is, the intrinsic value minus the market price all over the intrinsic value times 100. Next, he looks at the price to earnings ratio, or PE ratio for short. Buffett often looks at the PE ratio to assess if a stock is under or overvalued. A lower PE ratio could indicate the stock is undervalued, but it's not a standalone indicator. Return on equity. Buffett values the companies that have high ROE, as it indicates how well a company's management is using shareholders' capital to generate profits. Debt to equity ratio. Buffett prefers companies that are conservatively financed. He often looks at the debt to equity ratio to assess a company's financial leverage. While the dividend yield is not a primary criterion, Buffett does consider the dividend yield, especially for more conservative or income-focused investments. Let's look at an example business. For instance, let's say we have a business of a fictional company called TechEase to see how Warren Buffett might arrive at a final investment decision. First, he'll try to understand the business, the circle of competence. The industry of this business is cloud computing. And let's say Buffett understands this industry well. The economic moat of the business. Let's say it has strong brand recognition and it also has proprietary technology. The financial statements also show a revenue growth of 15% annually with profit margins of 20%, with low debt levels and positive cash flow. Assuming the projected cash flow for the next 5 years are 100 million, 110 million, and 120 million, 130 and 140 million, using a discount rate of 10%, the intrinsic value can be calculated above to be 447 million. After we calculate the intrinsic value, let's look at the margin of safety. Assuming the current market price is 400 million, the margin of safety is calculated above to be around 10%. Next, let's look at price to earnings, or PE ratio. Assuming the market price per share is $40 and earnings per share is $4, the PE ratio would be 10. Finally, let's look at the return on equity, ROE, and the debt to equity ratio. Assuming a net income of 80 million and shareholder equity of 200 million, the return on equity is 0.4 or 40%. Next, the debt to equity ratio, assuming a total debt of 50 million and a total equity of 200 million, the debt to equity ratio is 0.25 or 25%. Finally, the last factor that Buffett considers is management and other qualitative factors, like a competent and ethical management, high customer loyalty, and favorable regulatory environment. After all the qualitative and quantitative analysis, Buffett makes one final conclusion. The company has a strong economic moat and falls within Buffett's circle of confidence. Financials are strong with strong revenue growth, profit margins, and low debt. The intrinsic value is higher than the market price, providing a margin of safety of 10%. The PE ratio and ROEs are favorable. Debt to equity ratio is conservative. Thus, given these factors, Warren Buffett might likely consider Tech East to be a good investment opportunity, especially given the market margin of safety and strong fundamentals.